Hey guys, I'm John Fryer. Welcome to Fryer Funds, welcome to my kitchen, and welcome to the Fryer Feast series. In this series, we took $15,000, we're investing it into individual companies, with all investment decisions made over the weekend to be executed on Monday. This is for people who work 9 to 5, who don't have time to trade during the week or make decisions during the week, so we focus on the weekend execution and go from there. Now, I want to point out, this is not financial advice, this is not legal advice, consult your own advisors, and make your own decisions. But with that said, let's dive in, see what happened this week, and where we're going from here.
Alright guys, as always, not financial advice, not legal advice, consult your own advisors, and make your own decisions. But, well, with that out of the way, let's get into it and have a good discussion this week. So the Fryer Feast finally closed over 19,000 for the week. It hit that point a couple times, but hadn't closed for the end of the week until this week. So that was nice. Up 1.3% for the week. So the moves we made kind of worked out. And then the S&P 500 was only up about 1/3% and has kind of stalled here at the top. Assuming that Upland Software and Zillow don't gap up tomorrow, I'll just buy a share of both of those. Otherwise, I'm leaving the rest of the portfolio alone. So kind of basic, not a lot going on. The volume on SPY is actually low, which is actually, I think, the next point here. All right, cool. So yeah, I just wanted to kind of talk about a bunch of things going on because there's not a lot for the Fryer Feast this week. So I just wanted to kind of chat and talk about a bunch of the things that are going on and go from there. So the SPY, which is the largest and most popular ETF that tracks the S&P 500, it's not the one that I use. I prefer VOO from Vanguard just because it has a little bit better return because of their lower fees. But they both track the same thing. But the SPY is the more common one and is bigger. But yeah, the volume has been really low the last couple of weeks compared to certainly what it was during the pandemic times. But even going back to like December of last year, the volume's kind of low. So I think a lot of investors and a lot of people are just kind of waiting, especially the bigger investors. I think a lot of the trading going on right now is more newcomers, Robinhood traders is what a lot of people in the industry are calling them. So yeah, with this low volume, once some sort of news comes out, whatever it is, volume will spike and we'll see a lot more volatility. And so we can kind of take advantage of that, I think, because we've already positioned during this low volume with a good portfolio here, with the barbell that you might have heard about from like Jim Cramer and CNBC's and other investors. The barbell where we've got some in recovery stocks, about 1/3, some in direct beneficiaries, and then of course just the big cap and other long-term ones. But anyway, yeah, so we'll see what happens between the US and China. We'll see what happens with the election. We'll see what happens as states go to open or close with the virus, if there's a vaccine, all that kind of stuff. So until there's big news, I'm expecting a lot more kind of stable, small, very range-bound week to week. And even when the volume picks up, it'll probably still be range-bound week to week, but there'll be a lot more intraday volatility as things rotate and move around. And then the NASDAQ, it's hitting all-time highs. We've already seen some rotation out of it. We might see rotation back. We'll probably see a lot of volatility in the NASDAQ. But the S&P 500, probably less volatility. But the NASDAQ will probably be pretty volatile. That's kind of what I'm thinking is what's going to happen with this going forward. At least kind of what I've noticed. Until some sort of big news comes out, something changes. All the earnings are kind of out. There's a couple earnings this week that are kind of interesting, like Home Depot. But for the most part, most earnings are out. People are doing research now, repositioning, rotating, things like that. So we're kind of ahead of the game a little bit, which is good. That's generally the best way to invest, is to be ahead of other investors, figure out what they're probably going to do, invest in it, and let it ride up. So on that note, I'm still trying to figure out and decide what are people going to want to do this winter. Over the summer, camping was a big winner, which I didn't see coming. But so what's the equivalent of camping for this winter that we can invest in? I don't know yet. But I'm still looking out. If you have any ideas, let me know. And we'll look and see if we can find out where's a good place to invest for winter activities. Besides the obvious, like obviously people will be streaming, so Netflix, I'm glad we bought that for now. We still have Roku and Viacom, of course. Amazon, if they do a stock split, that'll be really nice because we can get in on that. Tesla already announced a stock split, so we might buy that after it splits. We'll kind of see where it's at. But yeah, for the winter, I kind of want to figure out what's going on. So this next point, completely different that I wanted to talk about, was Ray Dalio and Warren Buffett. So if you don't know who Ray Dalio is, he's a really big hedge fund. He runs Bridgewater Associates and is one of the more popular guys for real investors, or big investors, real investors, whatever. And most people know who Warren Buffett is. He's the legend investor. But Ray Dalio came out with the all-weather portfolio, and then Tony Robbins popularized that in the book Money Master the Game, which I'll put a link down in the description with a book by Jim Cramer. So if you want to start learning about investing a little more, those are two books I definitely recommend, is Money Master the Game and Get Rich Carefully. They both go over things like 401ks and how the stock market works and mutual funds and all that stuff. That's where the all-weather portfolio came into play. But with that, I wanted to touch on, I made a video back in March for the all-weather portfolio, the Golden Butterfly, which is another really popular portfolio, and then the Friar Pie that I came up with. And I just kind of wanted to take a look at their progress thus far. I'm still putting $100 into each one of these every week in the M1 Finance, but it's not really exciting, and I haven't been motivated to like make a 2-minute video on each one and say, here's where it's at this week. But I just wanted to take a look and see what they've done thus far this year and where they're at compared to the S&P 500 or VOO. So January, so Portfolio 1 is the Friar Pie. Portfolio 2 is the all-weather. I guess I actually think I can rename these. Hold on. Portfolio names, custom. Oh, perfect. Okay, cool. So we can do Friar Pie, all-weather, and Golden Butterfly. So let's do that. Does it actually give me? It does. Cool. All right, cool. So you can see this here. So back in January, the Friar Pie did the best. The S&P was down just a little bit. Then in February was actually a really good month up until the end for the S&P, and then that's when the sell-off started. And the last video I made was in March, so it only had up until February's data. So we didn't have March's data, and March was the biggest sell-off for the S&P 500, down 12% in a month, which is huge. I think that's the worst all time. I know it's definitely the quickest all time to the bottom, but we weren't at the bottom at the end of March. We were a few points higher than that because the bottom was on the 23rd or the 26th or something like that. Anyway, so they were all down, but the Friar Pie and the all-weather were only down about 0.5%. The next month on the recovery, the Golden Butterfly did recover the strongest, but still was not as high. If you look over here, you can see where the balance is. So they all started with 10,000 beginning of the year in theory in this. And you can change your inputs and stuff. I'm just setting this to see the percentages really. But even after that recovery, it still was below your starting $10,000 amount, as was the S&P 500 here. And it had a really good return in April as well. And then May, they're all about 1%, other than the S&P was up almost 4 or 5, I should say. And then same with June, everything was up about 1.5%. And then, yeah, July was the big recovery. They're all up over 5%. But in the end, the Friar Pie for the year is the best, 11,833, so 18.3%. The all-weather's close with 15.5%. The Golden Butterfly is only 8%. And then the S&P 500 is only 2.4% for the year overall. So the S&P 500, if you bought at the beginning of the year, you're still up, but only 2.4% after 7 months. Meanwhile, the Friar Pie, 18.3%, and during the worst sell-off, like in history, or at least the quickest, down less than 0.5% for the month. That's really good. Same with the all-weather. So I just wanted to kind of show you and update that and what these are. So if you don't know, if you haven't watched that video, these are the allocations. These are the tickers. VOO, S&P 500. TLT is long-term bonds, U.S. bonds. TLH is more of a midterm U.S. bonds. IAU is the ticker I like to use for gold. GLD is another one that a lot of people use. It's more popular, kind of like the SPY is more popular than VOO. DBC for commodities. IJS is small cap stocks, and that's for the Golden Butterfly. And then SHY is really short term, 1 to 3 year bonds for the Golden Butterfly as well. And so these are the percentages you put in to each of these tickers, and then that's how it calculates it. So yeah, this is the Friar Pie. the all-weather portfolio, and the golden butterfly. And this is the one in the Money Master the Game book made by Ray Dalio. So yeah, I want to talk about that. But so both of them bought a lot of gold, which is really interesting for a couple different reasons. Warren Buffett for the last decade or so has really been against gold, which makes sense actually. Gold has not done that well over the last decade. It's kind of been they call it the lost decade of gold. And Warren Buffett seen that coming and has not invested in gold. So now he's buying gold, or has bought gold over this last quarter. We'll see if he buys more this next quarter, because gold is up quite a bit, or at least it seems like it's up quite a bit. So they're putting a lot of money in gold. And then Ray Dalio, he's a really big economist, has studied a lot in history and stuff. And the way the economic cycle works and things, he thinks the U.S. is really coming to the end of its economic cycle, and the world power is going to shift over to China. And he's actually started putting money where his mouth is there. And you can see that he's actually started really heavily investing in China, with China exposed ETFs, and then a lot in Alibaba, which is a good company anyway. I think he put some in Tencent maybe, but Alibaba was his big one. And he also dropped U.S. bonds, TLT, in his major portfolio. He might still have some somewhere. I mean, we only have so much exposure, I think. But yeah, really interesting moves. Ray Dalio saying that China is going to be the next world power. And you add that to Trump trying to block TikTok and WeChat, Tencent, and ByteDance. Does Trump see the same thing happening as trying to prevent it? Or is he accelerating it necessarily on purpose? I don't see him doing that, but is the blocking there part of this shift into China's world power and Trump's trying to keep it? And if he is he doing it correctly? Is that going to work? If he isn't, why? And how does that come in with the election and Biden, and what is he going to do? This is going to be kind of really interesting to see how things play out over the next year on this. And who has the presidency, and how these blocking goes with the virus itself and the trade wars. Yeah, it'll be really, really interesting to see if we can kind of keep on top of it. We can invest in the same things, or in the right things here. For now, in my other portfolios, I've actually pulled out of Tencent. I don't even think ByteDance is publicly traded. And I also pulled out of Alibaba because of all the trade wars and stuff. It might be time. I don't know, with the trade blocks and things, I don't want to put money there, because if all of a sudden we're just say at war with China, I'm not going to say like an actual bombing war. I don't think it'll go that far. But if we're in a massive, I guess you can say trade war, that's what everyone's calling it, whatever. If we're in a big trade war, I don't want to be invested in China companies. Even Jim Cramer says Alibaba's good, though. Alibaba is a really nice company. Baidu is another one that's interesting because they're down recently and they're the Google of China. But I don't know. So I'm keeping an eye on it. It'll be interesting to see kind of what happens there. I don't know. So yeah, I want to talk about those. And I do own gold in my other portfolios, or well, mainly I've got a lot of money in the Friar Pie and all-weather portfolio in other ways. So I do have gold, but is it time to put more into gold even after its recent run-up? It's pulled back a little here, but I don't know. Anyway, yeah, so something to think about. Give me your thoughts down in the comments or hit me up on Facebook, whatever. But yeah, so just a couple kind of cool things. So next, the unemployment bonus didn't get past the end of July. I think I talked about this last week. So then Trump said $400 going forward, but that's still kind of in flux. They can't seem to come to some agreement with whatever they're negotiating about. I don't know. I don't really care. But what I do care about on that, if it is $400 or if it's $300 or whatever it is going forward, a lot of people were making more money off of that bonus in regular unemployment than they were when they were working. And I think a lot of them couldn't afford iPhones, and so they bought iPhones, and they bought other things that they couldn't normally afford because, I mean, that's just kind of how people react, right? So I wonder if Apple's big quarter and all these retail sales growing, other than auto sales have not grown, but all this retail growth and spending was because of this unemployment bonus. And now that it's smaller, and now that it could end up being quite a bit smaller, if things don't open up well, or even if they do, how bad are sales going to be going forward now that all these people that were taking in this bonus aren't spending it? So what are the quarters and earnings going to look like this next quarter? Even if we do open up and we do get a vaccine, what are earnings going to look like for these companies, and particularly Apple, because they're in a unique situation. Like I said, they had fantastic sales. They blew the quarter out of the water, right? Stock jumped. Really glad we were in it. It was actually pretty impressive. But how much of that was because of the unemployment bonus? We really don't know. It's, or at least I don't have a way of figuring that out. But I think that was a big part of it, my personal opinion. So does that mean Apple, they might have another good quarter, but they might, going forward, not have that great? I know Circus Logic, I think is the name of the company. They're a big supplier for Apple iPhones and other devices too, but Apple's like 80% of their business. They had a good quarter, of course, because Apple did, but their forward guidance wasn't as good as people expected. And I actually haven't read their earnings call yet. I need to do that. But if their forward guidance isn't that great, and their stock dropped because of it, which might be a buying opportunity, is that because they see that Apple's demand starting to slow down with the unemployment bonus being gone, or is something else going on? So it's hard to tell. I do want to read through their conference call. I haven't done that yet. But yeah, so Apple's kind of in a unique situation with that. And they also get a lot of business in China. And I don't know, Apple's in a unique situation with everything going on. Of course, there was the big hearing a little while ago that Apple was a part of, that they're trying to not be part of a monopoly in a sense, which brings me to my next point, actually. Epic Games. If you don't know, Epic Games makes Fortnite, which is like the largest-ish game right now, or has been in the world. So they started a big lawsuit against Apple and Google, but the big news is Apple, because of the 30% cut they take in app stores. So for this, Epic Games released a way to buy in-game cosmetics through Epic's website, and then those purchases would be applied to your characters on all devices, including Apple and Google. Well, technically, that's against the rules for Apple and Google. They say because Apple, what they didn't want is people going to buy things through the supplier's website, not going through Apple Store to pay for it, for security and protection and to make sure fraud and all that other jazz. But at the same time, they take a 30% cut, so if you bought a super special looking skin for your gun in Fortnite, Apple got 30% of that sale. So if you bought it for $1 or whatever it is, I actually don't play this game, I don't know much about it. But if you buy this gun skin for $1, Apple would get 30 cents of that. Well, if you buy the same skin through Epic's website for your computer, because this is a game that's cross-platform, for your computer, and you bought it for $1, Epic Games would keep all of that. Well, transaction fees and stuff, whatever. So Apple wouldn't get a cut if you bought it through your computer. Well, I don't know. It's kind of unique. I'm kind of on Apple's side in that it does make sense to handle distribution on their operating system, their software, their ecosystem. And if you want to be part of that ecosystem, you have to pay your Apple tax, for lack of a better term. And Google does the same thing, whatever. But at the same time, once someone has the app, oh, how funny.
Sorry,
my phone picked up that I said Google. Once you're in the ecosystem, once people have bought the app, or Fortnite might be free on Apple, I think, buying in-game cosmetics and having Apple get a cut of that, even though it's a cross-platform game, I don't know. It's interesting. It's an interesting situation because, yeah, if it's an Apple exclusive app, and it's because of Apple that you're able to reach their billions of users, then it does make sense for Apple to get a cut. And they also, of course, should control, to an extent, what goes through their platform and the experience they give to their users. But at the same time, Apple had nothing to do with Epic Games beyond distributing it to their billions of users, which, yes, distribution is a channel that in traditional, like, physical goods, you do pay your channel logistics or whatever it's called. I lost the word here. But I don't know. It's really, really unique. And so Spotify, they kind of tried to fight Apple on this in the EU recently. Facebook recently, after Epic Games released this, came out and said that they're on Epic Games' side. So whatever ends up happening, it's really unique, and I'm not sure where I land on that. But so if Apple is forced to change things up, however it lands, either they cut costs or cut the cut they take. They cut the cut they take. Okay, if they lower the percentage to say 20%, that's a 30% drop in revenue on their App Store. Well, their App Store is huge. They make a lot of their money through the App Store. So a third of that, I don't actually know the numbers here. I could look, but I'm lazy. So say 40, I'm going to say 50%, just for easy math. 50% of Apple's revenue comes from the App Store. And a third of that gets taken out because they drop their percentage to 20%, which is one third of 30. Then all of a sudden they're losing out on a total of 15% of all of their revenue. Their business just dropped 15% because of the lower cost to their App Store. That's going to have a huge impact on their business and the stock. Now, granted, it's still going to be the biggest company in the world at that point, probably. But it is going to have a huge impact on their stock. So it might be worth taking a look at how much of our portfolio Apple is after the stock split, because we only own one share right now. We're going to own one share, period. If they weren't doing the split, we just own one share because it's Apple. But after the split, when we own 4 shares, we might cut it down and sell 1 or 2 of those just because we don't know what's going to happen with this and how it's going to play out. Maybe they don't cut it from 30 to 20%. Maybe, actually, that just reminded me. If Google does a stock split, that'd be really nice. We can get it on them. But their stock price is too high for the Friar Feast. I do own it otherwise, just a little bit, 1 share. Actually, in all my portfolios, I just put 1 share of Google. So I kind of hope they do a stock split like Tesla is. But anyway, so back to this. So maybe they don't cap, or maybe they don't do a 20% cut. Instead, maybe they cap the amount of income. Like once you buy the app, that's 30%. And once you start making in-game purchases or in-app purchases, maybe they only do 20% for that, or they do 30% up to a certain dollar amount, like the first $20 or something, and then 20%, or they just stop at $20. I don't know. Maybe they allow for another way to install apps, like an unofficial app store that's like, okay, this isn't Apple approved. This is just an app store for other apps we don't get money from. We're not checking them. Install at your own risk, kind of like Google does, because you can side install things on Android for Google, right? So you can still install Fortnite on an Android right now. You just can't do it through the Google Play Store. You have to go through side channels and enable, I think it's called third-party apps, developer apps to be installed, which is nice, which is one of the reasons I really like Android, is because you can do that. It makes it a lot easier. But for a lot of people, that's a little more difficult. So who knows? I don't know. Apple's really unique in this situation. Same with, Google's not the big news just because they're not Apple. But Google's in the same boat, but because you can side install, Google's not the big behemoth. They're still a big company, but Apple's the biggest in the world now after that Saudi Aramco or whatever that oil company is. They lost a lot of money through all of this, so Apple's technically really is the biggest company in the world now, market cap wise anyway. So who knows? It's really kind of interesting, and I'm kind of on Apple's side in that it makes sense because it's their operating system, their users, they control the experience for their users. They want to focus on security, of course. They created this huge ecosystem, so they should get a part of it. I mean, props to Apple for what they've done. But eventually, at some level, somewhere, it's no longer Apple's work. Well, it is Apple's work, but a 30% cut is pretty big. So I don't know. It's kind of interesting. But anyway, so that I just wanted to talk about that, and if something happens and changes here, which I think something will, I just don't know what it's going to be, Apple's business is going to change to some level. So that could hurt the stock price, along with less iPhone sales. If a lot of people bought iPhones because of the extra unemployment bonuses and stuff, Apple could have a rough year next year. Or rough for Apple. They're still going to make like trillions of dollars or billions or whatever. But a rough year for Apple itself. So anyway, yeah, so a couple links here. I'm going to put these down in the description as well. But the Money Master the Game book and Get Rich Carefully book, links to those, like I mentioned earlier. The FriarPie portfolio visualizer that we looked at here, there's a link to it. And then Epic Games with the subject we just stopped talking about. So this is really kind of cool. Back in 1984, Steve Jobs was there, right? This is a long time ago. Apple released a commercial that was not a direct, but basically a direct, and everyone kind of knew IBM was the Apple of the day. The big behemoth that everyone didn't like was IBM. And so Apple released a commercial back in 1984 to fight IBM and come out with the Macintosh and really start dominating the computer market. Well, Epic Games made a spoof of that. Whoops. That's actually really that's cool. I didn't know Google Docs could do that. So Epic Games did a spoof of it and kind of made a similar commercial, but against Apple this time, using Fortnite graphics, I guess. Fortnite art. And so the main character running up is a big character in Fortnite. All of the crowd that you see there, they're from Fortnite. And then the enemy is Apple in a sense. So yeah, I thought it was really well done. It's really cute. It's really cool. So check those out. Again, all these links will be down in the description as well. But if you want to, for whatever reason, type it in from the video here. There you go. Also, this document will be linked down in the description as well, so you can get to it through that. But yeah, I think that's kind of all I want to talk about this week. Not a lot going on. Really low volume. Tomorrow, if Upland Software and Zillow don't gap up, I'll buy a share for the Friar Feast here. I also wanted to know if anyone watching this wants to see what trades I make otherwise throughout the week, because sometimes Monday isn't the best day. Sometimes things spike up during the middle of the week or spike down during the middle of the week. So I make trades during the week too. I'm not a day trader. I'm more of what's kind of considered a swing trader, in that I'll buy a stock because I think it's at a good price. When it comes up, I might take profits, or I might completely take it off the table, or if something changes. So it's a lot less strict in terms of percentages. It's still I still kind of keep track of it, but not as heavily as I do for this, just because this is weekend only. This is the way I used to invest before I got more heavily into it, in that I would focus very much on how much percentage I put in each company, where I was at, things like that. And I've done really well over the years, but over the last few months, this has kind of become my bigger thing. And so I'm making trades probably generally 5 to 10 a day. Maybe not that much. It depends on the day. Like I said, volume is definitely down right now, so it's been a little different. When volume was up, it was different. But anyway, so if you guys want to know more about trades that I make during the week that aren't part of the Friar Feast, just otherwise, let me know. But yeah, that's all I've got for this week. A little different. I just wanted to kind of chat and talk and go from there. I might start doing this a little more going forward, depending on what's going on, just to kind of throw things out there and get ideas. So yeah, ideas for what people are going to do for the winter, ideas for what you think might happen with Apple, with the China thing, the election, gold. But yeah, that's everything I've got. So we'll talk to you next week. Thanks, guys.